Today I'm going to be talking about the best investments when inflation spikes. Now, inflation can happen at any time, and it's really important that your investments are able to withstand these fluctuations in prices. And even though the stock market has been volatile recently, it doesn't mean you have to stop investing. And with a little bit of research and patience and time, you can find some great investments for your portfolio. Let me show you what I mean. So here are 4 ways that you can safeguard against inflation. Number 1, invest in a variety of stocks and bonds or an index fund, which tracks the market as a whole. Number 2, diversify your portfolio by investing in multiple types of assets and not just stocks. You can look at commodities like gold and silver, real estate, or cryptocurrencies even. Make these risky investments make up no more than 5% of your portfolio. Number 3, as inflation rates rise, and as a result interest rates rise, then value stocks start to look more attractive. Now, value stocks are stocks trading for relatively cheap valuations relative to their current earnings, sales, book value, and cash flow. Also, you can use certain measures to value stocks to see if they're value-based. So for example, a high dividend yield is usually a value stock, as well as a company with a low price-to-book ratio, meaning a price-to-book ratio of 1 or less, and also a low price-to-earnings ratio, meaning PE ratio. And these stocks are considered cheap because investors feel that they have unfavorable positions in the marketplace in terms of innovation, competition, and the ability to produce a significant increase in the stock price. And they could also be trading cheaper because of bad news, as well as issues with the management team or potential looming legal issues, Facebook, anybody. Yeah. Now, a benefit of value stocks is they offer decent dividend payments to shareholders, like Coca-Cola, ticker KO, or Procter & Gamble, ticker PG. Number 4, please be careful of growth stocks. Now, a growth stock is a company that is anticipated to grow at a rate significantly above the average growth of the market. And these tend to be newer and smaller companies and or those in growth sectors like technology. And a couple of examples trending in recent news could be Tesla, of course, which is quite large, it's not a small cap, as well as Palantir and Square, anything that's growing quickly. And these stocks generally do not pay dividends because companies want to reinvest those earnings to accelerate growth in the short term. Now, growth stocks often look expensive, trading at very high price-to-earnings ratios. But such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share price up. And growth investors love to value companies based on future earnings potential many, many years from now. But in times of high inflation and high rising interest rates, these stocks can perform much worse because they expect to earn the bulk of their cash flow in the future. And as inflation rises, those cash flows will be worth a significant amount less as interest rates rise. And it's interesting, actually. I find that university students and recent graduates are more inclined to be value investors because when you learn finance, you're taught to buy cheap stuff, meaning companies with low multiples. But regardless of your investing style, you will want to invest in companies that people are going to like and consider how relevant this company might be in the very, very long term. Now, a cheap or an expensive stock is subjective. When I used to own a lot of LinkedIn and NetSuite, ticker LNKD and ticker N, before they got acquired, people would tell me I was crazy. They would say, it's so expensive, Chris. It's 100 times earnings. But in my mind, it was only 3 times my earnings estimates in 5 or 10 years. And that sounded like an amazing bargain to me at the time. And so just like my hero, Wayne Gretzky says, you don't want to skate to where the puck is. Instead, you want to skate to where the puck is going to be. So we need to invest in stocks that people are going to like and consider where they will be in 5 or 10 years in the future. I'm Canadian. I had to mention Gretzky somewhere. Now, if you'd like to learn more about my process for valuing a stock, please download a new resource I created at this link here called 8 Tips to Pick a Stock, where I go through my investment research process, which analyzes FVT, which stands for Fundamentals, Valuation, and Technical Analysis. And I hope this advice will help you with your research and finding investments for your portfolio. Now, if you enjoyed this video, please let me know by clicking the like button, and I'll create more content like this. Thank you.